Well, welcome everyone in the Zoom audience. Terry Magady here for our presentation. The first thing I do is, and I think everybody in the bar does, we thank our sponsors. So I want to thank the Sanborn team and Nancy Sanborn. They are real estate brokers who specialize in probate, trust sales, sales regarding older people, all of the real estate issues that people in the Elder Law Committee and actually Trust and Estate section deal with. So thank you for many years of sponsorship, the Sanborn team. So you'll see I have an outline which you should have received already. You could follow along in the outline. That's the general agenda that I'm going to take. And then what I'm going to try to do is talk for maybe 45 minutes, and then I'll have questions and answers, and then we could have, I could try to respond to questions you have. So, what I decided to do is just a few minutes ago, I heard Linda speak yesterday about it in an estate planning seminar. She started off with something personal about how she got into business. So I thought I'm going to interject that right before we start in our agenda, because many of you, I believe, I know. So many eons ago, I was a real estate attorney. So I got into this business because I have 3 kids, but my oldest is 29 and she has Down syndrome. So that got me started in this whole area of people with helping people with disabilities, law-related people with disabilities, and that tied right into older people. And the very cool thing is that not only now do I have I have 3 kids, I have my daughter who's 29, but I have a son-in-law with Down syndrome too. So they've been married for 6 years at next month, and they live on their own, and both of them have Down syndrome, and that's how I got into the business. So let's start with the introduction. I like this quote that I saw from an estate planning attorney who I work with, and right at the beginning of COVID-19, she put this in her little, line on her emails, and I thought it was nice. Mr. Rogers, when I was a boy and saw scary things in the news, my mother would say to me, "Look for the helpers. You will always find people who are helpers." So that made me, that gave me some inspiration, like right at the beginning when all this stuff started, because, with whatever you're doing, we're not medical professionals, but in whatever you're doing, you could be a helper. So the goal of the talk is, you'll get something about government benefits here that in one way or another is going to help people. So that's it. And now, to get into the substance of the talk, why? That's a good way to start before you go into it, to the details of what you're talking about. Why am I speaking about this? Because I personally, with phone calls, have, at least empirically from my own experience, experienced people having more of a demand for long-term care. And I'm just me, but I'm imagining it's happening elsewhere too, throughout the country. Why is that? Again, anybody reads the papers, it's not only COVID or watches news in any way you get it. It's not only COVID-19, but next thing I quoted, a Wall Street Journal last week, CVS warns of non-virus health crisis. And that's in the news a lot, that people are ignoring other medical issues, and consequently, they're experiencing problems that are not related to COVID-19 directly. And therefore, people are having issues that are going to relate to needing care. That's one issue. The next thing that is causing a demand, at least I believe, in a need for long-term care is not only the these non-COVID issues, but ventilator issues. Everyone now knows, ventilator, because it's been a headline in the news. In my own business, I've known it, about ventilators for, 25 plus years, however long I've been doing the elder law. Why? Because not so much for the medical reason. I hear about them on people, vents and trachs in the business, because of the cost issues, not necessarily the medical issues. But people come to me and someone has been on a ventilator and they find out that, after a max 100 days, their Medicare is not paying anymore, their supplemental insurance is not paying anymore. And unlike just regular skilled nursing care, the subacute care with a ventilator and a trach is enormous. Its private rate is something like $25,000 a month. So people have a choice: either they pay that, which very few people can, no matter how much money you have, or you find a way to go on Medi-Cal. So that I'm very familiar with. And even though hopefully people are getting off ventilators, some people are staying on the ventilators. And even the ones that are getting off are having repercussions. So that's from the need. There's on the need for long-term care issue. The other caveat with everything is that I'm noticing with people that call me, people want to stay at home more, which is understandable. It's typical in a conversation that, somebody calls me and then we both conclude, of course, you don't want to go into an institutionalized setting, which would be the case otherwise anyway, before COVID-19, but all the more so now. People want to stay home and get care paid for there if possible. Now, Medi-Cal. There are two issues that I see when people call me. On the one hand, people don't consider Medi-Cal because they always say things like, oh yeah, I don't qualify, or he doesn't qualify, which is just not the case a lot of the time, because the rules are unusual. We'll get into those momentarily. So always someone should at least consider Medi-Cal, consider it at least for paying long-term care. But the last point I make on this, the outline, number G, is also equally important. Other alternatives should be considered, because in the same way people are calling me about Medi-Cal, I personally feel that it's one of the a service that I provide, which is to tell people that Medi-Cal is not appropriate for you. It's not that you can't qualify, but there are downsides to getting on Medi-Cal. And it doesn't pay for everything you may think it pays for. So often your family calls are looking for Medi-Cal. Sometimes they just never thought, oh, they could qualify. But even probably more often than not, they want to be on Medi-Cal, but they don't really appreciate what that means. And after you go through issues with them, you find that Medi-Cal is not the best way to go many, many times. But you really have to go through the issues to determine that. Now let's go to the next part of the outline, Medi-Cal eligibility. This is just to give you a feel what the toolbox is, because people come to you in this business and they say things like, are you hiding assets? Of course not. Of course not. I'm a lawyer. You tell the truth. You tell the truth on these applications. You tell the truth, period. You're not hiding things. Oh, you're doing these trusts. Trusts are just one really small aspect of the whole Medi-Cal planning field. So it's more than that. It's more than that. And just to give you a feel, this is like behind the curtain, like Wizard of Oz. See what's going on with the wizard. Give you a snapshot. Why do people? What goes on with Medi-Cal planning? Issue number one: there are many assets considered unavailable or exempt, and they're going to surprise you. I'll probably get questions, people, after you hear some of the things, people will say, I don't believe it. I can't believe it. But it's true. So you're using unavailable, the category of unavailable or exempt assets, And you're also using categories unavailable and exempt income, because people have a misunderstanding about that too. Next, not only are there certain assets that are exempt and unavailable, Medi-Cal, you'll see shortly, has an unusual way of counting them. They don't count assets and income the way everybody else counts things. What do you do a lot of the time? Really, it's just refining, tweaking things. You change one type of an asset to another type of an asset, one income to another type of income. Another thing you do is get on one Medi-Cal program so that really you can get on a different Medi-Cal program, because there are lots of different Medi-Cal programs. The most common one I'm just going to mention now, well, there's something called MSSP you get on in order to get Ihss, which is an in-home care program, but there are many of those. The next thing you do is you try to get priority for these things called Medi-Cal waivers. Medi-Cal waivers are mostly for care at home. There's some that also provide care in an assisted living facility, but there are issues and ways to get priority for them. We'll bring that up later in the presentation. You go to court to get certain court orders, particularly for spouses. You gift within rules. There's, we'll get to that shortly too. There are ways to gift if it is appropriate. If. One of the biggest issues is the year 2017. In the state of California, that year changed things big time in the field of Medi-Cal, because for the most part, the state took away its right to recover against assets, because most people have heard of this concept. Oh, they're going to, you spend money on, the Medi-Cal program spends money on you, and then they want to take your house. They want to get your assets out afterwards. For the most part, that diminished greatly, because in 2017, basically assets that are upon death avoid probate, also avoid Medi-Cal recovery. And that's all. That's it. So, and so when people used to transfer homes with all sorts of negative ramifications to avoid recovery, it's really, that part of it's not relevant anymore. In fact, it could be a bad thing to do a transfer. The only place there really is recovery is when you have a probate estate and you didn't avoid probate, or two, you have something called a first party special needs trust for someone that you established it for under 65. And you have to be very careful, because you do that and you're handing a recovery right to the state of California, where otherwise it's not there. Finally, on the eligibility section, I mentioned in A, we're going to focus on Medi-Cal, because Medi-Cal is the big item for paying for long-term care. But there are other programs out there. I mean, one of the biggest ones that's ignored, which is subject to state budgetary concerns coming up, but one of the biggest, or probably the best program for in-home care in the state of California is not a Medi-Cal program, but it's a program provided through regional centers for people who are, quote, developmentally disabled. And the program's called Supported Living Services. I see people probably at least a couple times a year that somebody just doesn't know about it. They don't know about it, to ask about it, even to get the care. So there's supported living services. There's Section 8, which is almost non-existent now for newcomers, but something else called affordable housing is. You see these apartment buildings being built all over our city and county. Most of them, where they get density bonuses of some kind, they set aside a certain number of units for affordable housing, very inexpensive housing. And the qualifications are almost identical to Section 8 qualifications. Then, of course, you have Social Security, you have Supplemental Security Income, SSI, you have veterans benefits, aid and attendance. But let's get to Medi-Cal. Assets. Here's the sample of things that are not counted for one reason or another. And then we're going to go afterwards, after we go through these things, then we're going to talk specifically about COVID-19 programs. First, we're going to talk about assets that aren't counted. and then income's not counted. And then we go to specifically COVID-19 and how it interacts with Medi-Cal, the programs for COVID-19. Assets, home. Now, the home can be an apartment building. It could be your 5-unit apartment building, 6-unit apartment building. You lived in one of the units. It could be in a different state, a different country. I get people a lot of the time sad because it's a sad. A lot of my business is sad. So people come here. People are visiting from wherever it is, whatever country, whatever state. They come to LA and they got sick. It's usually parent visiting kid here, and their home is someplace else: Mexico, France, Florida, you name it. Anyway, the home it doesn't have to be in California. It doesn't have to be your current residence. It could be a prior residence that you quote unquote intend to return to. I could discuss that more later, but there you go. Like other real property. Let's say you have this home, wherever it may be, in the West Side, that's valuable. And then you've got another property that you bought a long time ago because you're older. And the property tax assessed value is low. Let's say $100,000, $50,000, whatever it is. You bought this home in the 60s, the 70s. And over the years, you refinanced, or maybe you got a loan on it. And the loan is for $100,000. Well, if you have the Medi-Cal considers the property tax assessed value, not the fair market value, unless the fair market value is lower. But you have a property tax assessed value that says $100,000. You have a $100,000 loan on that property. For Medi-Cal purposes, whatever that property may be, it's worth zero. Another property, let's say there's another property. You bought another real property and you brought it with your brother, okay? And again, all these people do this a long time ago. So they bought it with their brother. Brother signs a statement. I'm not selling the property. Also, unavailable, it's called, not counted. There's yet other property that's in the process of sale. I don't use it too often, but I've used it once. We were, moving around asset here, there, and there was one asset we were calling exempt, another asset we were selling, and actually we did put it in a special needs trust and then use the money. We were doing different things with different assets. But during the sale process, not counted. And you put it over to special needs trust, not counted with a recovery right, but then we spend the money on care. Next, property, but incapacity and no power of attorney or trust, or no conservatorship. This comes up a lot. People always say, you may as well have a durable power of attorney, which of course is good a lot of the time. Or why don't we go in for a conservatorship? But when you do those things, the minute you get the conservatorship and control that day, or if you have a power of attorney where you can control the property, that property, whatever you're getting at with the power of attorney or conservatorship, is just changed from being unavailable to available. So I've had people in nursing facilities with, thinking of one, they had very, very valuable raw land, unimproved land in the Midwest. When shopping centers were worth something, people wanted to build a shopping center on it. Many acres, but the person was older, 90, they had a low basis, but there was no power of attorney, no conservatorship. Fortunately, Medi-Cal didn't count the property. And back then, there was a recovery right, but it was, the state got paid back something. But the bigger thing was we got to keep the property and get a basis step up for this. One was 90 years old. So property that, but the concept is property of someone who they still use the old term of incompetent. Therefore, it's unavailable. You can't liquidate it. Limited partnership, LLC, operating agreement. Look in there because there could be, or there often are, restrictions on the ability to transfer a property. I had one recently where we had an operating agreement, and before you would think, well, there was a lot of money coming in, but now the property, say it was property with a commercial tenant who stopped paying. So you don't have income, but how do you sell it? You couldn't sell the interest in the LLC interest because of the restrictions in the operating agreement. Next, retirement accounts. That's your own retirement account. We're going to get into this with COVID-19 shortly, but your own retirement account, your own IRA, if you've elected any distribution from it, no matter how small, it's called unavailable. Doesn't really make sense why the term unavailable is used, but there you go. And it's not counted. Your spouse's retirement account or plan, your spouse's IRA, whatever it is, $1 million, $2 million, $3 million, whatever it is, not counted. That's called exempt. Another one that surprises people, third-party trusts now that are not coming from you or a spouse. These come across my desk too, every, a few a year, that people think that, oh, you didn't have special needs trust language in there, which is better. You plan for it and you have discretionary trust language. But for Medi-Cal purposes, if the trust is even a support trust that is funded by someone else other than you or your spouse, your deceased spouse, let's say your uncle left you a couple $100,000, the asset's not counted. And you have to look at the distribution requirements, but you can really avoid the income being accounted too. That always surprises people. First party special needs trust, people have heard about, but you have to be careful. It's under 65 and it's a good tool for the right time, right situation, but be careful because you are creating a recovery right. So I've had quite a few situations where, other people would do a special needs trust, but you think this person has kids, they're incapacitated, they're in bad shape, they're younger, accident, whatever happened to them, and they have little kids or any kids. Would they want a special needs trust to keep on Medi-Cal so that the state just recover all the money back and their kids wouldn't get the money? No, you try to think of other alternatives. Pooled trust, a little more detailed to explain, but it's potentially for people over 65. A lot of people don't like those because they, you give power and authority to a third-party trustee that you don't really know, but they're right for the right time too. Gifts, also this surprises people. One, for community-based Medi-Cal, which is the Medi-Cal that funds in-home supportive services at your home, the Medi-Cal that you have if you are not in a skilled nursing facility, the penalty for giving away your property or your cash is zero. There is no penalty. You have to be careful about that because of all sorts of reasons. There are lots of good reasons not to give away your property, but and whether there's authority for that, but there's no Medi-Cal penalty for that. The Medi-Cal penalty, which you do have to be careful of and think in advance about, is when it comes to skilled nursing benefits, long-term care Medi-Cal. Then they have a penalty. But people confuse that. They say, isn't there a look-back period? And can't you not give? It's not the way it works. The look-back period is just a time period where they ask you the question, did you give away money? You answer the question. But there are all sorts of exceptions to it. I mean, exempt asset transfers are one of them. But exempt, you can call them exempt transfers too. You give away more complicated discussion under what they call the average cost of nursing home care in California, a figure that changes around February or March every year. You give away under that amount. Let's say now it just moved to a little north of $10,000. You give a check for $10,000 to somebody and it's gifted, there is no penalty for that. But if you gave, let's say an example, you have $100,000. You gave $100,000, you would have a penalty. Take the $100,000, divide it by average cost of nursing home care in California, you have a penalty, maybe 9 months or so penalties, meaning you can't be on skilled nursing benefits Medi-Cal for 9 months. You give away instead 10,000, 10,000, 10,000 serially, there's no penalty. ABLE accounts. ABLE accounts are nice, really they're for people who I believe 26 is the cutoff. People who are disabled before 26 years old. But the big tool that you use these ABLE accounts for is the ability to pay money from the account and not have it count as income. Really for something nice for affordable housing, not Medi-Cal. It doesn't count for Medi-Cal either. But it's used as a tool now for people who administer special needs trusts and don't want income to be counted in certain ways. I'll come under that in the next category. But you use these ABLE accounts to get the money. The other one, this is also people are very surprised about, assets that are not counted at all. The expanded ACA, Obamacare, Medi-Cal in the state of California is not based on assets. It's based on income only. And it's for people under 65 who don't have other insurance like Medicare. But this tool comes in very handy. I had people, someone, terrible accidents, but this person had minor children, and we didn't want a special needs trust. And fortunately, there was the person did not have Medicare, so they had no other insurance. They only had Obamacare, Medi-Cal. Only income is counted, certain type of income. And certain type of income does not include state and federal tax-free dividends from mutual funds, not interest, dividends. More complicated to be discussed, but a great tool for people. Again, my goal is not to enrich the coffers of the state of California. My goal is to be a helper for families. Their community spouse resource allowance, if you've got, it's a spouse when one's in skilled nursing or one's part of a waiver program, the other spouse gets to keep certain assets. They change that number every year too. It's a little north of 128,000 now. And you go to court to get an order to increase that number if you need to. Go up a higher amount. That takes more discussion. Okay, let's move over to income that is not counted. First, when you've got either these skilled nursing benefit, Medi-Cal, or you've got a waiver program, and you've got spouses, you have two different ways to count income. So you could choose one or another. You can choose one way is just the income in somebody's name alone. The other way is the spouse that's not part of the waiver, it's not in skilled nursing facilities, can keep a little north of $3,200 every month in income. But you look and mix and match where is it best to use your income, to put income so you don't have to pay, so Medi-Cal can pay for something. Support orders to adjust that number. You can go into court to get a support order in the probate court to increase that number above the 3216. Insurance deductions. This is something common, very small tweaking issue. If you have an income in a certain amount with a Medi-Cal at home, let's say you're at like $1,500, I'll say, for example, a month income. Then you kind of are, it's challenging because then you go to a Medi-Cal program where you can only keep $600 of your money every month. But if you can use insurance deductions for vision plan, dental plan, those are the ones used, and get your countable income down to just south of $1,300, then all of a sudden you can keep all your money. Loans, when you borrow money, this reverse mortgages are used for this, or any other loan. When you borrow money, that's not income that's coming in. Indirect income. This is also, there's so much, people get confused about this. People think you're administering a trust and you're spending money on this beneficiary. Isn't that income? Isn't Medi-Cal going to count that? No, Medi-Cal has a different definition of income than the IRS. It can be countable for IRS purposes, federal and state income purposes, as income and have whatever consequences there are that come with that, including K-1s, which is just a reporting requirement. But for Medi-Cal purposes, as long as you don't pay the money directly to the person, that's one way, it's not counted. So go to all these other people whatever it is, caregiver, institution, this, that, and the other, that's not the Medi-Cal definition of income. The Medi-Cal definition of income is something that's paid directly to the beneficiary, and you have to listen to this definition carefully, if you pay the entirety of housing, food, clothing, or utilities, if you pay the entirety of any of those, you get this allotted imputed amount, which doesn't amount to that much anyway, but you can easily manage it so you don't pay the entirety. Pay 95% of housing, pay 95% of utilities, or whatever it is. So it's very easy to avoid potentially income being counted for Medi-Cal purposes. And you have to distinguish that from SSI. SSI is different. People have heard of SSI. There's when you pay toward housing or clothing, there's a particular reduction you get. But we won't go into that now. But just remember, SSI definition and Medi-Cal definitions are different for income. And actually for affordable housing, Section 8 also, they're different. And that's where the ABLE accounts come in handy for Section 8. Next one is not income from an ABLE account. Great tool for that. And I mentioned already the tax-free dividends for expanded Obamacare ACA Medi-Cal. Let's now, as an overview, let's get to COVID-19 programs. How does this all, let me mention a couple COVID-19 program issues, and then we'll see what's happening with help you get for COVID-19 interact with Medi-Cal. First, one is just one issue that needs to be mentioned, and that I have that on right at the top for COVID-related programs and effects. There's no Medi-Cal termination now for 90 days, starting in March 16. So and it may be extended. So that gives you an opportunity to catch your breath and do planning when you're looking at things from my perspective. I've got a matter now where we're funding a trust. We're not doing a special needs trust. We don't want recovery. We want the younger kids, help them. Mom is taken care of, really. But we need it's being funded now, and the fact that there's no difference in Medi-Cal, even you can't terminate it for a few months, comes in handy. So I call it a safe harbor for assistance here. Now let's go step by step. Medi-Cal, how does it interact with everything else that people are maybe getting positive-wise in terms of government programs related to COVID-19? $600 a month unemployment benefits, the extra amount you get. That's nice. That's nice if you're the recipient of that. But you have to be careful. What if you are on the Obamacare, Medi-Cal, the expanded Medi-Cal program? $600 extra a week. Not if I said a month, it's a week extra. Perhaps that's going to put your accountable income over the threshold for your Obamacare Medi-Cal. So maybe for a short period of time, you're okay, but longer period, maybe you're not. So good thing with potential negative consequence. On the other hand, if you have a different type of Medi-Cal, maybe you've got skilled nursing benefits Medi-Cal, your spouse is in a skilled nursing facility, or you're using one of these Medi-Cal in-home waiver programs, and the working spouse now gets unemployment, and whatever way you use to count income, you weren't really paying attention to that income anyway of the other spouse that's not disabled, then it could be great. You're home free. But as I mentioned, like all unexpected money, which comes up in my business, personal injury settlements, inheritances, things of that nature, you have to consider what you do with the money to shelter it from Medi-Cal. Next, the stimulus, the $1,200. This is one, at least they specifically in the Act, the CARE Act, I think it's called. They specifically address public benefits and the $1,200, saying the income is not counted negatively toward your public benefits as income, and you could keep that $1,200 and not count it toward your public benefits for a year. So what that means is it could mean if somebody's setting aside as kind of a rainy day fund, you segregate it very similarly to what we do with Nazi war reparations that are also something income that's not counted. Japanese internment camp reparations also not counted. We segregate those from other income, so it just is a clean exempt asset. Then when a year comes, you have to decide what are you going to do with the $1,200. You're going to spend it, gift it, change it into another exempt asset. The other issue that comes up with this $1,200 is that many times you've got people who are disabled adults who would normally get this $1,200, but parents in this case often take the disabled adult as a dependent. And you have to look at it tax-wise because maybe it's not doing anything for you tax-wise. So then when it comes to your 2019 taxes, maybe you don't want to take the person as a dependent, or at least you think carefully about it before it's just an automatic box you check to call someone dependent, because then you don't get the $1,200. The individual doesn't. So the PPP program, very popular, lots of news about it. From strictly Medi-Cal perspective, it's nice that it's a loan to something. Let's say you're the non-disabled spouse working, you get a PPP loan. At least that's not income. Then once you get it, though, you have to think, how fast are you spending it? Because maybe it's going to count as an asset. So nice because it's a loan, no income. Asset-wise, you have to think, is it going to count? Is it not going to count in your Medi-Cal planning picture? The 2020 IRA RMD exception for this year. So part of the act is that you don't have to take your required minimum distribution in 2020. At least that's what I hear. That's what the act said in my read of it. So read of the descriptions of it. So that presents a planning opportunity potentially, because normally you do, if you're now, you're 72, you have to take required distributions. So and as I mentioned before, the IRAs may not count, but as an asset, the income does count in some way. So we also often have issues where non-countable asset, but we have income coming in that's not counting, that does count because of the RMD. Well, this year you can treat somebody with who normally would have an RMD requirement in the same way that we do with other younger disabled people who have IRAs. Let's say you're 50 and have an IRA, and you don't want to count it because you were, God forbid, you were in an accident or a medical malpractice injury, something like that, and you don't want this asset counted. The way to do it normally would be, okay, you take a micro distribution, say $25 a year, presto changeo, assets no longer counted. Now, when there's no RMD requirement for 2020 for older people, you could have an opportunity to do the same thing if you want to avoid income but keep an asset counted as unavailable. Next, tenant protections. Now, older people, I'm looking at it from the older person as the landlord. Everybody, people want rent, so they want it, and it helps. But it may not be happening due to all the city, state, county restrictions on evictions, on rent payment related to COVID-19. So you have to keep in mind that when you're doing any planning, you're looking at assets for this older person or disabled person, whoever you're looking at here, and looking at it from a Medi-Cal perspective, that at one time this generated income. I've had them already. Some these good commercial tenants, and you would think, oh, I've got income here it's a Medi-Cal problem. It's a good Medi-Cal problem, I guess, because you have income. But now the tenant has sent you a notice that it is euphemistically saying, we're abating rent. That's the term. Or maybe you just have tenants who aren't paying, residential tenants. So you have to think, one hand, bad, but on the other hand, now you have assets without income that could be counted toward Medi-Cal and help for the reducing Medi-Cal share of cost. Landlord protection. If forbearances people are getting with difficulty, but they're getting them. And maybe you want to, if you have a forbearance on your own home, fine. Okay, there's no income coming in, maybe, unless you're doing Airbnb or whatever, have it, leased to somebody else in the home. Fine, it's not to have a Medi-Cal effect. But on the other hand, if you get a forbearance on your second home, where you have rental coming in, that the interest portion of that installment that you're not having to pay to the bank is now not deducted from your income, and therefore you have an increased Medi-Cal share of cost. So you have to just watch out for that. You watch out for that. Next, this is a category I've not seen yet, but I call it COVID-19 unavailability. You use this concept of unavailability when you can't liquidate something. So, I've used it even with several times with real estate, even a shopping center once, where there was litigation, cannot be sold, therefore not counted. You now may have an opportunity, maybe COVID-19, with whatever's going on with the real property, tenants not paying, tenants not leaving, tenants not allowing people in to view the property, restrictions on viewing the property, could potentially make a case that it's unavailable right now and not counted for Medi-Cal purposes. The last two issues in our 4 minutes here, 3 minutes before I hit the 3:45 mark. In-home supportive services, IHSS and taxes. In-home supportive services is the Medi-Cal program that is most used for care at home. That it's most well known, and acronym is IHSS. But the interesting thing about IHSS is when the recipient of IHSS and the caregiver live under the same roof, the money that comes in for the caregiver, which usually talking about a adult child here, is state and federal tax free. So you get in-home supportive services coming in. You're trying to, the family's just trying to piece together money to make ends meet. $2,500 coming in, let's say. That's a nice amount. Let's say it's $2,000. So, but if now you're living together under the same roof, which that's the direction people have been going, all of a sudden that in-home supportive services income is not taxed anymore, it's a nice benefit. You have to do a form before, when you do the tax return, but it's a nice benefit to have it come in to the family member, tax free. Finally, in 2 minutes here, the in-home waiver priority. In-home waivers are the ability to I'm simplifying this, to get care that would normally be used to pay for you at a facility, to have it be paid at home. You get more than in-home supportive services. It's a complicated program normally, but here's the big issue. Normally there are waiting lists for the program, and there are waiting lists, not normally. There are always waiting lists for that program. But if you are in a hospital or a skilled nursing facility, when you make an application for it, then you move to the head of the waiting list, and you do not have a wait anymore. You have a wait to go through the process, but you no longer just have to wait in line till it's your turn on the waiting list. So now with so many people, not so many as much now, but whatever number of people are going into the hospital, skilled nursing facilities, that's bad. We don't want people to have that. But on the other hand, when you're in a facility, it allows you to apply for this waiver. And you got to do it when you're in there, not when you come home. When you come back home and then you apply, then you just got demoted. You're back on the long waiting list. So, but for couples, and this is an unwritten rule. I'm going to do the written part first. First, for the waiver, if you want to apply for it and you're in a facility, you have to be on Medi-Cal. So you have to get on Medi-Cal there, then apply for the waiver. Two, but if you're a couple, nothing written about this. This is just the practice. You should be able to, as long as things haven't changed in the past like 5 to 6 months, you should be able to get priority on the program if you're part of a couple, because they know that there are things you do as a couple that can get someone on Medi-Cal. I'm going to call it relatively easily. So then you still get priority for the in-home waiver. By the way, the waiver can also be used for assisted living, but so often people want it for the few assisted living facilities that use the waiver, but so often people want to use it for home. It gets you more than in-home supportive services. And timed that exactly. It's 3:45. Let me see what kind of questions we have. Oh, someone just asked about, can you go into a little bit more about regional center services? Are they connected to Medi-Cal? They're really not at all directly connected to Medi-Cal. If you have, there are no, the only, and they say, is there no, are they connected to Medi-Cal? Is there no connection? Okay, let me do a few minutes on this. The regional center benefits are state paid. They're not federal government. Although maybe there's some behind the scenes allocations here or there, but it's a state of California benefit for people who are developmentally disabled. Developmentally disabled means someone who has before the age 18 had one of these things. These are the easy ones: cerebral palsy, epilepsy, autism, Down syndrome. Those are easy. Then also, you've got people who are you've got the other category, people who are slow, developmentally disabled. And if you can get into that category and you show that disability was prior to age 18, I've had people come in who've never plugged into that benefit at all, that they just never applied. You know, their parents wanted to avoid government. I'm thinking of different people right now. But for the one person I'm thinking of, it saved his life. It saved his life, kept him at home. He was running out of money. We did some Medi-Cal planning, but he lived at home all his life. You know, cerebral palsy, sharp mind, but couldn't really, was very physically disabled. But supported living service, he got on regional center because he had one of the categories, cerebral palsy, approved prior to age 18. And doesn't matter what assets you have, that's some qualifications to that, but it doesn't matter what assets you have, you get your regional center client, and the benefit is SLS, supported living services, which pays pretty good rates for at-home care. There's an indirect connection with Medi-Cal. Someone wanted to know. It's not a Medi-Cal program, but if you're supposed, when you get any regional center benefits, you're supposed to always try to attempt to get alternative services. But if they're not alternative services, then regional center picks up the tab. Hopefully that's going to be good enough for that. Okay. Can someone with wealth qualify for any of these plans? Yes. You know, you can put 2 and 2 together. Just picture yourself with, that's just the reality. Picture yourself with an expensive single family home on the west side. Picture yourself with another expensive home that you own with your brother. Picture a third home that you also own and property tax assessed value for next to nothing, a little loan on it. There you go. IRAs. So someone can have wealth. And that it comes up mostly, how about the subacute problem? People contact me, it doesn't matter how much money you have. If you start getting a tab for $25,000 a month because of a vent and a trach, you want to get protection. Okay, wait a minute. Let's see. No, now I'm getting things. Okay. what do you get? If someone has IHSS, how do you find out what the reimbursement will be to Medi-Cal? I'm going to give you a general proposition. So number one, remember what I told you about avoiding recovery, okay? So 2017, so you shouldn't even have to deal with this issue, but a little more detailed response is IHSS actually behind the scenes has different categories of money coming into it. Most of those categories, it appears that there's not even a recovery right for. It's a complicated answer, but I'd say, recovery, try to avoid, you can avoid it so easily, since 2017, just do it. So, okay, can you explain the clawback in more detail? Clawback, I assume is that recovery? If you mean recovery, recovery, thank you. Okay, recovery is concept. Medi-Cal spends money on you. The state of California spends money on you. It's for services or items over the age of 55. They have a right to recover back that money that they spent on you when you die. But that's the bad news. Do the bad news first. But the good news is, unless there's a probate that's open. I mean, a probate, the probates we all have. There's not a recovery. There's not a recovery from a revocable trust. There's not a recovery from an IRA with a named beneficiary. It's not a recovery with an annuity and named beneficiary. It's not a recovery. I was saying case law on this subject matter now, but the subject of this one case, but it's like joint tenancy. You avoid probate. They don't have recovery. So except for these first party special needs trusts, that's a built-in recovery. There you go. For IRAs to be exempt, is any amount of distribution or calculated required under IRS? IRS, I don't know what IRS is. That'll be somebody else's wheelhouse to talk about. But exempt, I know, for it to be exempt, and it's called unavailable, which doesn't really make sense, but you can take any amount out. It's unavailable. The rule is you elect a distribution, it's considered unavailable. There you go. So that's why we have people get injured, they're younger, sad, early illness. You elect $25 a year, IRA's not counted. Okay, how far back do they look? This is for the look back part. Look back. Now I'm getting lots of questions. Oh my. So how far back do they look? The federal law changed many times, a long time ago. State law still is they look back 30 months for Medi-Cal. They ask the question, what did you transfer in the past 30 months? Federal law is different. And of course, as lawyers, we all know federal law trumps state law, but Medi-Cal is unusual. That's not the way they apply it. The state law is how things are implemented right now. Okay, wait a minute. Okay, what's this? What if 70 and get personal injury settlement, continuing care, wheelchair with 70 is, let's see, it just depends with gag reflex concerns. I think, always you have to look at what are the opportunities here? 70, you can't do expand Obamacare. Can't do that. Special needs trust, 70, can't do that. Can you do an exempt asset? Maybe you just spend the money. Maybe you don't do Medi-Cal. The age 70 is more problematic than the age 60. So, but we'll have to look at things in more detail for that. Do you spell COVID? About the safe harbor COVID? Wait a minute. You're creating a trust. Now the beneficiaries. Wait a minute. Since March. Oh, they can't terminate. Someone's asking about this safe harbor. They can't discontinue. So pretend March 16, you got a bunch of money. Okay. I don't know, whatever, $1 million came in. Ding, you got $1 million. Pretend you're on whatever Medi-Cal program you want to be on. I don't know, pick anyone. You're good for 90 days. They can't terminate your Medi-Cal. So within 90 days, start planning to see what else you could do to stay on Medi-Cal, if that's what you want. Remember, it's not always the best thing. Okay, there may be other better solutions. Receive Social Security. Wait a minute. Qualify. If you have an elderly client who suffers from dementia and receives Social Security, if you have an elderly client who suffers from Alzheimer's dementia and receives Social Security income and residential income, what steps should family take to qualify for benefits under long-term care? Now, assuming you have to look at each situation is pretty individual. Each individual, it depends. But I gave you some rules, general propositions. How about rule 1? Qualify for long-term care. What are you talking about? Are you really talking about skilled nursing facility here? Or a waiver? Dementia, Alzheimer's. If you're talking about dementia, Alzheimer's, elderly, 65, live for a long time versus 95, not going to be here very long. You're going to weigh what the benefits of Medi-Cal are going to be. But if you're talking about strictly a skilled nursing facility, if there's residential income property, what's the assessed value? Is the assessed value, that's going to be the value for Medi-Cal. What's the loan on the property? That's going to offset the value for Medi-Cal. What are the net income and expenses? That's going to, offset your share of cost. If you even want to do gifting, and we're able to, and if it were appropriate, which you may not do until later. I don't like doing things in advance because of their negative consequences to everything. Then you have to look at basis step-up issues, and I'll leave it to you tax people out there. You want to transfer and retain an interest to get a step-up in basis at the same time. What if, can someone qualify for any, can someone call, let me know, considering, yes. Okay, I think, did I answer? For example, I think I addressed everybody. I mean, some of the answers I don't think were really, I don't think they're complete when you're just, when it's just about a particular situation. For that, call me. I like talking through things because then you get a feel for the situation. Because email, you just get you got a narrow question where you really have to look at the whole picture. And remember, when you do look at the whole picture, because we're at the end of the time for our program, remember that you look at Medi-Cal to see if it's appropriate, because you don't want to forego that opportunity. But on the other hand, many times if you really look at it deliberately and carefully, you will say either one or two things. Either one, we don't want to take, Medi-Cal is not the best way to go for this particular situation and for what we're going after because of all sorts of other consequences. And two, you may say, you can do it later, because why not wait till later if what you're doing now for the purposes of Medi-Cal has a negative consequence associated with it, which happens a lot. And I think it's 4:00, and I think I got all the questions addressed in some manner. So thank you, everyone.